Hello and welcome back to our discussion on sources of funds for the virtual startup lab. We'll continue our discussion on the equity capital. In this session, we will try to understand the face value, book value, and the market value. We know the sources can be divided into equity and debt. And equity, we have also seen, is the money raised through the issue of shares and the profit generated by the business. But in this session, we will try to understand face value of the share, issue price of the share, book value of the share, and market value of the share. The face value or the par value of equity share is the value stated on the face of the instrument. The par value in India is generally, we see 1 or 2 or 5 or even 10. And the capital is always shown on the balance sheet at the par value. Normally, the dividend is calculated at the par value. So, this is an accounting concept, and you normally see the par value on the balance sheet. Issue price is the price at which the equity shares are issued to the shareholders. An issue price may be greater than the par value, then it is called issue of shares at a premium. The issue price may be equal to par value, then it's called issue at par. Normally, the issue price cannot be less than the par value as per the Companies Act 2013, with some exception of sweat equity, which we'll see later. Book value is an interesting concept which brings together the money raised by the capital, through capital, and the profit generated by the business. So book value of equity share is equal to the paid up capital plus reserves divided by the number of shares. Book value per share is also known as the asset backup per share. Assets minus liabilities by number of shares. That means in case the company is liquidated as on today, the value of the assets minus the value of liabilities divided by the number of shares will give you the book value per share. We'll take an example to understand that. The market value for listed company, the market value of an equity share is the price at which it is traded in the market. It depends on the demand and supply of the shares in the market. But in case of an unlisted company for a startup, there is determination of the market price depends on the various models that we can use, because market price is not readily available. So with this, let us take an example to understand the par value. So in this example, the balance sheet is given. Capital 100,000, reserves 500,000, bonds, creditor. These are the sources. So the par value is the value of the capital shown on the face of the instrument, which is shown on the balance sheet. The book value per share is a equity, capital plus reserves, or assets minus liabilities. Either way we can find the equity. Divided by the number of shares will give us the book value per share. So book value is not directly visible on the balance sheet, but can be determined. Market value is not at all visible on the balance sheet. What is seen is the face value, and book value can be determined. Let us see a company like TCS. The market price of TCS as on April, date is April 24, 2017 is 2,324.29. That is the price at which the TCS shares are available today. The face value of TCS share is rupee 1. the market value is 2000 something, the face value is 1, the book value is 465. So the value of the share depends on what value you are trying to examine, book value or the face value or the market value. So for a startup or a new company, you don't see this market value directly, but by using different models, it's possible to find the market value. However, the balance sheet of the company can tell us the book value of the share. Thank you very much.